Hello everyone, welcome to my module on how the economy works. Today we are going to go through some of the absolute basics you need to understand about economics in order to become a better investor. We'll cover concepts from the ground up, like the difference between goods and services, supply and demand, all the way through tracking how money circulates through an economy. This episode is the first in my educational series where I distill the critical things to know about economics, accounting, and finance so that you can understand not only why markets behave in certain ways, but to gain advantage over the uneducated investor and profit by creating your own investment thesis based on these lessons. Please note that my intention is to arm you with enough information for you to continue your education on topics that interest you, and that there is a wealth of knowledge that I am simplifying for these presentations. I'm going to teach you not only basic concepts you must know, but more importantly, how to think like an analyst. You have already demonstrated success by engaging this series, so continue becoming a better investor and utilize additional free resources online. Welcome again to Mind of an Analyst. Alright, let's begin with goods and services. An economy is essentially the sum total of goods and services produced and consumed from its available resources. So what's the difference between a good and a service? Well, goods are physical products that are created from raw materials. Services are transactions which are derived from the expertise of the provider and are non-transferable. To illustrate, I go to the market to buy a shirt, and while I'm there I also get a haircut. The shirt is an example of a good because there were raw materials that went into producing it, like cloth and thread. The haircut, on the other hand, is a service. It is something which I benefited from personally, but I cannot transfer it to anyone else. Just like in the case of going to a doctor. If a doctor cures my cold, no one stands to benefit from that other than me. No one else's cold was cured by my doctor, just mine. That's how to remember the difference between a good and a service, is transferability. I can physically give my friend my shirt, but I can't give my friend my haircut. Next, let's turn to supply and demand. In a town, there are 10 people who go to a market every day to purchase rice. There are 2 rice farmers that produce just enough rice to feed these 10. All demand is satisfied, and the market is in balance. Balance is a critical component to a well-functioning economy. So what happens if a bad storm comes through and wipes out one of the farmer's rice crop? All of a sudden there's only enough rice to supply half of the people. This is called scarcity. The market is out of balance. Now, some of the townsfolk value their rice so much that they are willing to pay more for whatever is available. So they offer to buy all of the rice at a higher price. Even though the price is higher, all of the supply is now gone, and therefore the market has returned to a new balance. The opposite is true if farmers produce too much rice. This is what's called a surplus. In order to sell all the supply, they would need to price the rice just inexpensively enough so that they could get rid of all of it. The market would again return to a new balance, or as economists describe it, an equilibrium. Now, some of you may be wondering, well, how can the market be in balance if half of the people who wanted to buy rice weren't able to? Well, there is often greater demand for a product than what is available, and price reflects that. Think of the electric car industry. Currently, most people, given a choice, would drive a car that was ecologically friendly, but because of limited manufacturing capacity, only a certain amount of cars can be produced. So people with bigger wallets are willing to pay higher prices today for the luxury of driving a rarer car. In the future, as more electric cars are produced, prices are going to come down and more people will buy them. But as things stand today, the higher price reflects the scarcity, and the market is indeed in balance. This surplus and scarcity happens every day, and you can see market prices reflect this balance on what is called the commodities market. Daily market prices show what everyone is willing to pay at that moment for a commodity. Go and take a look at the price of rice today. If you Google commodities market, click on a link and look to the agricultural section. You'll find all kinds of interesting materials being sold there in that market exchange. So how do we pay for the goods and services we require at the market? Well, money, of course. And where does money come from? The Treasury Department normally is responsible for printing physical currency, but each country or region has a central bank which controls the supply of money to its economy. In America, it is called the Federal Reserve Bank. In the European Union, it is known as the European Central Bank. These financial institutions attempt to keep an economy healthy and growing by setting policies which directly influence the supply and flow of money. They are the government's banker. They promote steady growth through encouraging full employment and controlling inflation. Now, there are two important ways that a central bank controls the flow of money. First, through open market transactions, the Fed buys and sells government debt to and from investors. These are called treasury notes, bills, and bonds, which we will discuss in detail later. These are sold to everyone from retail customers like you and I to businesses, pension funds, and even foreign nations. And second, the Fed sets policies like the reserve rate, which tell retail banks how much money they need to keep in their vaults at one time, which in effect lets the banks know how much they can lend out to their local economies. Here is how local banks generate money, demonstrated through this reserve rate. The current U.S. Federal Reserve rate for retail banks is 10%. So that means that banks are required to keep in their vaults 10% of all the money that is deposited to them. That also means that they are allowed to loan out the remaining 90% to their customers and the market. So say you needed a mortgage for a house, or a car loan, or a business needed money for some new equipment. The bank would utilize the unreserved 90% of money to draw from. But here is where it becomes interesting. In the case of buying a car, the bank gives you a loan, you pay your local dealer in cash, and what does the dealer do? He goes back to the bank and deposits that cash. Because of the reserve rate, the bank has to hold on to 10% of that dealer's deposit, but it is now free to loan out 90% of the remainder again. When you think about this on the larger scale happening over and over again, you will see something called the money multiplier effect, where the amount of money that is available to an economy is directly related to how many times a bank is allowed to loan out that money again. The math works out like this. The money multiplier equals 1 divided by the reserve ratio. So when the central bank wants to adjust how much money is available to its economy, they can simply increase or decrease the reserve ratio, and banks have less or more to loan out. The government doesn't have to print or destroy any physical money. So let's look closer at how money moves through an economy, the circular flow of income and spending. For this section, I recommend pausing the video so you have time to read all of the individual items on the screen. There are three entities in an economy in which all money flows to and from and through. Highlighted in the green circles, they are household, government, firms, or businesses. Let's track money, in this case British pounds, through the domestic flow of the economy. Look at the bottom purple arrow. This represents wages paid for working a job. The money is earned by households as income and paid to us by companies. We then pay taxes to the government, and they in turn provide us with public services like police or public parks. We also purchase goods and services with our money, so it flows out of households and back to corporations based on demand. Companies also pay taxes on their earnings, but the government actually makes purchases from them as well, like computers or building project contracts. Next, we're going to include trade with the rest of the world. Money flows out of our economy when we make purchases overseas in the form of imports, and money flows back into our economy when the rest of the world buys our products. And finally, we include the critical financial markets to the flow of money chart. When money is taken out of our economy in the form of savings deposits, you or your bank can engage the financial markets and invest in companies or projects you think will help grow your wealth. That money flows back into the economy and helps companies grow by giving them more money to better build their businesses. So, how do we measure how big an economy is, and what makes an economy grow? Don't worry about memorizing the math or understanding all the terms precisely at this point. Just be aware of them, and definitely research anything and everything further, as they are good to know when it comes to investing and the economy. GDP, or Gross Domestic Product, is comprised of consumption, that's all of our goods and services, investment, which is how much companies spent to buy new equipment to build a better business, remember you're investing dollars, government spending, which is how much money the government has spent into our economy, and net exports. Net exports is the difference between all of the imports and all of the exports our economy made. If we bought more goods from the rest of the world than they bought of ours, it would make our economy shrink by that difference. This is also called the current account. If the goal was a growing economy, you might have noticed that as the government spends more, our economy also grows. So why not spend unlimited money? Well, if everyone around you all of a sudden had $1 million more equally, the value of the dollar would be less. Prices would automatically go up just as much as that million you were given. That's called inflation. You pay more for the same product. Now, if you remember the Fed's two most important functions, they were to control inflation. A little bit is healthy for growth, and to encourage full employment in the economy. The Fed wants our economy to grow at a steady and predictable pace for a long time, and that would make it a booming economy. If we have problems and the economy doesn't grow for 2 consecutive quarters, we enter what is known as a recessionary economy. So let's take a quick look back over what we've covered. An economy is made up of the production and consumption of goods and services. This production and consumption is a direct function of supply and demand, and pricing reflects equilibrium. Finally, central banks adjust the flow of money into economies in order to keep growth healthy by limiting inflation and promoting employment. I encourage you to read periodicals like The Economist or free online news outlets about the economy and see if you can apply what you have just learned to a current article. Think about how everything is interrelated and what would happen if something were temporarily out of balance. How would the economy correct? Post what you learn in the comments below and invite your friends to join in the conversation. Stay tuned for the next module, Everything You Need to Know About Accounting, coming up now on Mind of an Analyst.